Hello, this is Rochelle Agatha, and this is the lecture on Chapter 10, which is Purchases and Cash Payments. If you recall, Chapter 9 talked about sales and receipts, so now we're going to talk about purchases and cash payments. There are several learning objectives in this chapter, most of which are to make sure that you understand how to post cash payments and all the different pieces that go along with the journalizing, and talk about a perpetual accounting system. Learning objective 1 is recording and posting purchase transactions. The purchases is an account that records the cost of merchandise bought for resale. So once again, you're talking about the merchandising function. A purchase account has a debit balance. It's classified as a cost, and it represents all cost directly related to bringing merchandise into the store for resale to customers. So it is a function related to merchandising. Here's an example where somebody purchased $4,000 worth of Barbie dolls on an account from Mattel on July 6th. So here is your purchase account. It's a cost account. It has a debit balance. So when you look at the T account, your purchases are debited and they go up. On the flip side, you bought it on account because it tells you that in the transaction. So your accounts payable is credited, and there's your subsidiary account from Mattel. So here's your control account and accounts payable, and here's your subsidiary account. And here's what it looks like in the general ledger. Now there you must keep track of any purchase returns and allowances. Just like we kept track of sales returns and allowances, we keep track of purchase returns and allowances. So here's an example. Chow received several defective dolls, and Mattel issued a credit memorandum for $500. So here's your accounts payable, it's liability, and it is decreased by the return. And then your purchase return and allowance is a contra cost account. It has a credit balance. So instead of just crediting purchases, you're going to credit purchase returns and allowances so that you can keep track, just like we did in the sales side. With sales returns and allowances, you want to have a contra account so that you can track how many times you have to return something. And here's what it looks like in the general ledger. So you see the account that is hit here. Then there's purchase discounts. So Mattel offers a 2% cash discount if the invoice is paid within 10 days. So now we're the purchaser, just like we saw the sales side. So if we pay within 10 days, we're going to get this discount. So here's your accounts payable. So you owe $3,500 after the return, and you're getting a 2% because you paid within 10 days, so 2% of $3,500 is $70, and your cash is $34.30. And here's what it looks like in a journal entry. Net purchases is the actual or net cost of purchases. So it's purchases less purchase returns and allowances less purchase discounts. That is net purchases, and that is important. Here's your gross purchase less your return allowance less your discount. Now we talk about freight, and sometimes freight can cause some problems with students because there's so many acronyms. So FOB destination is the seller pays the shipping charges. The legal title passes to the buyer when the goods reach their destination. So you think about FOB destination, the seller is paying it till the stuff gets where it needs to go. FOB shipping point is the buyer pays the shipping charges. So the legal title passes to the buyer once the goods leave the dock. So if you kind of try to think about it that way, I think it's easier than trying to memorize the acronyms. Purchase discounts are not taken on freight. Recording and posting purchase transactions. You're going to prepare a multi-part purchase requisition. A copy sent to purchasing, a copy sent to accounting, and a copy is kept in the department making the request. Now remember, if this is done in a computer, a lot of this might happen transactionally through a computer program, but it still is the proper way to post purchases. Here's what it would look like in a manual system. Here's a purchase order. So it has all the important information about where you're purchasing and the amount and what you're purchasing. The sales invoice is prepared by the seller, so then the seller will send an invoice, and it has all the information on it. And step 4, when you receive the goods and complete the receiving report, a receiving report verifies the exact merchandise was received. Then the company A company does not record this purchase until the invoice is approved for recording and payment. So if you have a system and you're using a computer system, you may have a purchase requisition that's computerized, and then it's approved and it turns into an electronic purchase order, which is sent to the vendor. And then at the point that the goods are received and the invoice is received, it's all matched, and that's called a voucher package. And then the invoice is paid. So here's step 5, verifying the numbers before invoice is approved. So just what I just mentioned. There's a purchase order number, a rec check, a purchase order check, a receiving report check, an invoice check, and approved for payment. So this is very manual, but this is what's happening behind the scenes, even in a computer program. So auditors look to make sure when a vendor is paid that all of these things are in the packet. There was approval for the purchase, approval for the requisition of the purchase, the stuff was received, and then it was paid for. Here's some transactions. Once again, these PowerPoints are out on Blackboard, so if you'd like to print these out and follow along on your own and try them on your own. So here's April 3rd, purchase merchandise on account for $5,000, freight of $50, terms 2 and 10, net 60. So here's what your accounts are. Purchases are a cost, debit $5,000. Freight in is a cost, and it's a debit of $50. And accounts payable is a liability, and it's a credit of $5,050. These go on the income statement. Liability sits on the balance sheet. Here's what it looks like in a journal entry. What is this freight in thing? Certain companies will call it different things. Some companies just call it shipping. So, this is a standard accounting term, but you might see shipping expense, something like that. Objective 2, recording the accounts payable subledger. Just like we learned about the accounts receivable subledger, there's an accounts payable subledger with all of your vendors on it. The normal balance is a credit. Accounts payable is the controlling account, and it has the sum of all the individual vendors and the people that you owe the money to. So here's our partial general ledger that we talked about in Chapter 9. And now we're down to accounts payable is your controlling account. And here's all of your vendors that were in your subledger. So you have these different vendors here. Here's your accounts payable subledger. So you have a little T account to represent every vendor. And here's your partial general ledger, and your accounts payable controlling account is the sum of all of your vendors in your subledger. Transaction 3, post and record. So this is the transaction we just did. So you're going to post it just like we learned in previous chapters to the different places. And freight in is an expense, purchases is an expense, and accounts payable is a liability. Objective 3 is preparing, journalizing, and posting a debit memorandum. A piece of paper issued by a customer to a seller. Nowadays, it's not necessarily a piece of paper. It usually comes via email, electronically, but it's the same purpose. So someone issues a debit memorandum, usually because there was something wrong with the product and they're giving you credit back. Notice here it says defective. That's what it's for. And here is journalizing and posting the debit memorandum. Accounts payable is debited, and a purchase return and allowance is credited. This is the contra cost, and the liability goes down because you don't owe for the defective product. And here's what it looks like when you book it in the journal entry. Journalizing and posting the debit memorandum, you can see here that you're booking it against Abby Blake Company. You can see accounts payable down here, and there's your purchase return and allowance account, your freight account, all the different accounts that are related to purchasing. So this is a good slide to print out. Learning objective 4, recording and posting cash payment transactions. Sometimes things are purchased on cash. Not always do they go through some kind of form of credit. And let's look at a transaction. Here's a closer look at how the April 12th transaction will be journalized. If you purchase something for cash, you're going to credit your cash. And if you got a discount, you're going to credit your purchase discount account. You're going to debit your AP for the whole amount. And then there's your sub-ledger account here. So notice your credits equal your debit. You got a discount for paying timely or for by paying cash, depending on what the terms of the discount are. Here's what it looks like in a journal entry. Here's a complete set of cash payment transactions. So if you printed out that previous slide, you can follow along, and this is a really good example. So you have prepaid insurance. You paid for a whole year of insurance or whatever term this was for. Then you paid off an account payable, Joe Francis Company. You had purchases on cash, and then you paid a discount. You got a discount for paying timely to Thorpe Company. And then you had your salaries that you paid cash for. So here's a whole set of transactions that are for cash. Here's what they look like when you post them for the month. So I suggest that you print out these slides and follow along and see if you can do them yourself on a separate sheet of paper before you start your homework. It'll really help you with these concepts. Learning Objective 5 is preparing a schedule of accounts payable, which is your AP subledger. Proof that the sum of the accounts payable equal to the control account. Only the creditors that you owe a balance will appear on the schedule. So these are the two people you owe money to, Abby Blake and Joe Sullivan. Notice it adds up to $7,130. And journalizing transactions for a perpetual accounting system. An inventory system that continually monitors its level of inventory is a perpetual inventory account. Merchandise inventory comes from the suppliers to sell to the customer, and the cost of goods sold is the total cost of merchandise inventory brought into the store. So a perpetual inventory system is every transaction affects inventory, every single one. Unlike a periodic system where you just run it through without running through inventory, you keep track of it and you force your ending inventory by doing a count. Gross profit on sales is the profit before operating expenses. So it's your sales revenue less your cost of goods sold is your gross profit on sales. Net income or net loss. Here's an analysis of you have your pretend like you're Walmart, and you have your sales revenue less your cost of goods sold is your gross profit less your operating expenses equals your net income. Your sales comes from either cash or accounts receivable, depending on if you buy on credit or pay cash. And your cost of goods sold is what is debited, and your sales are credited. And then your cash or accounts receivable is reflected, and your inventory. So let's go and look at a journal entry. Perpetual inventory system matches revenues and cost. It tracks what it costs to make the sale, and that's called cost of goods sold. And it helps control stocks of inventory as well as lost or stolen goods. So here you have a sale of a TV, $500. It costs $300. Your gross profit is $200. Recording merchandise transaction from the buyer's position. So now we're the buyer. We were the seller in Chapter 9. Merchandise inventory account is increased when merchandise inventory comes into the stores. Each order is documented by an invoice. This is the cost of bringing the merchandise into the store. It is not the price at which the merchandise will be sold. So inventory is reflected on your books at cost. So here's your merchandise inventory. It's an asset. It is a debit, and it goes up $7,000 because Walmart bought a flat screen TVs from Sony for $7,000. And then accounts payable is credited for $7,000. So here's your first transaction. You buy it, you stick it in inventory, and you bought it on credit. And here's what it looks like in a journal entry. Recording the merchandise transaction from the buyer's position. Not all purchases will go to merchandise inventory. Supplies, equipment, and whatnot that are not for resale do not go through inventory. These amounts will be debited to a specific account. So let's say Walmart bought $5,000 of shelving equipment. They're going to book that into an asset, and that's going to go to a liability. But this is not inventory. It's not for resale. The only thing that goes through inventory is what's for resale. Walmart noticed a damaged TV and issued a debit memorandum. Okay, so here your liability of AP goes down by $600 and merchandise inventory goes down by $600. In a perpetual inventory system, inventory is reflected every time something happens to it. Unlike previously where we were looking at purchase discounts and returns. Here's a discount. Walmart pays Sony within the first 10 days. The purchase discount will be recorded as a reduction in cost of inventory. So once again, notice when you use a perpetual inventory system, you touch inventory for everything that happens. So your accounts payable is debited for $6,400, and you have cash credited, and you have your inventory go down by 128 for that discount. And why are we doing this? Because when you use a perpetual inventory system, your inventory is reflected at the true cost of what's going on. So if you get a discount, that discount is reflected in inventory. And here's what it looks like in a journal entry. Recording the cost of freight, once again, inventory goes up because freight is $300 and you paid cash. So what I suggest is you print these slides out and you put them side by side and you go through the transactions under the first scenarios where we use the purchase discount and allowance, and then the second set we're doing now, which is under a perpetual inventory system. Recording merchandise transactions from the seller's position, sales revenues are earned when the goods are transferred to the buyer. So you earned revenue can be for cash and or credit. And here's an example of the sale of the TV for $950 on credit. You record the sales, and then you record the cost of inventory sold and the reduction in inventory. So for every sale transaction, there's actually 2 transactions going on in your books. You're going to debit your AR and credit your sales for the sale amount. You're going to debit your cost of goods sold and credit your merchandise inventory for the cost. Therefore, the difference is your profit. So if you can keep in mind that there are always 2 transactions for sales, recording sales. One is hitting the sales and one is hitting the cost of goods sold. Here's what it looks like in a journal entry. See, there's 2 transactions, one for the sale and one for the cost of goods sold and the inventory. And this is when there is a perpetual inventory system. Record sales returns and allowances. A customer returned a TV. There's 2 entries. We're going to take a look. Here's your sales returns and allowances and your AR, and then here's your inventory reflected and your cost of goods sold. Because under the perpetual inventory system, you have to always run everything through inventory. 2 transactions, because you're affecting inventory and then you're affecting what's going on with your cash and your revenue. Record sales discounts. Once again, you get a 2% discount for paying early. Here's your cash, your sales discount, and your AR. Here's what it looks like in a journal entry. Now let's summarize all the entries for the buyer and the seller. And this is a good slide to print out so that you can see all the different transactions that are going on. I realize there's a lot in these slides, so I highly suggest you print the slides out. Maybe listen to the video again with them in front of you and really hone in on the fact that there are lots of transactions going on, but they're very methodical. Here's the summary of the chapter, which there's a lot going on, as I mentioned. We talked about purchases, we talked about shipping, we talked about freight, we talked about the steps for buying merchandise and the steps for recording and the selling, and the accounts payable subledger and the controlling account, and the end of the month creditors looking at the ending balances of the subledger, and debit memorandums, payments of cash, and the perpetual inventory system. So if you have any questions, send me an email. Otherwise, I would really print these slides out and walk through the transactions as they're shown before you attempt your homework. Thank you.